All right, guys, what's going on? This is Ryan, aka Cantor and Clark, and on behalf of Josh Rager and I, we just want to thank you for tuning in to the BlockRoots YouTube channel. This week, we passed our 10,000 follower threshold, so we finally overcame that 10,000 barrier, and it's all thanks to you guys. So we appreciate every single one of our followers, and we thank you for tuning in on a weekly basis and supporting us. And just like all of our other videos, this video will be no different, except with this video, we're going to give out $200 in Bitcoin to the lucky winner who leaves a comment. So the only stipulation is that you are a subscriber to the BlockRoots YouTube channel, and then all you have to do is leave a comment and we will pick a random winner and give away $200 in Bitcoin. So hopefully you guys have checked out Phemex's new features. So if you visit Phemex.trade, you'll see that they have added spot trading. So if you do not want to trade derivatives or contracts, you can now trade Bitcoin, ETH, XRP, and Link directly into USDT. So the one fantastic thing about Phemex, besides just the incredible speed, was the fact that you can trade their derivatives into USD. So you didn't have to worry about getting into synthetic USD and doing all of those extra steps, similar to how you have to on other platforms. So now they actually offer these spot pairs and you could trade directly into USDT. So this is just one of the many things that we know are in the works, and rather has been in the works for a long time, and they have a ton of other things that are coming down the pipeline, and we're really excited. So if you haven't checked it out already, head over to Phemex.trade. Josh and I are partners with them, so we obviously do have to disclose that. We work directly with them, but we would not pick a team that we were not proud to work with and that we did not truly stand behind. They put out an incredible product and offer an incredible service. So in today's video, I want to talk about a simple and effective way to view the market that hopefully will not only improve your understanding of how markets work, but also of how to better operate within them. Okay, so what I tell you should also put in context where we currently are, or help at least give you a better understanding of why levels like where we currently are majorly important, and what it means when we approach these major contextual levels or inflection points, as I will sometimes refer to as. Okay, so before we get into this, I just want to talk about a recent update within the crypto news space. All right, so let's get over to that real quick. All right, so one thing that's exciting is Andreessen Horowitz getting into crypto more heavily. So Andreessen Horowitz is a famous venture capital firm. They have predicted the fourth crypto market boom. All right, now they've been a huge player in the technology space. As a venture capital firm, they've previously helped startups such as Twitter, Skype, Groupon, Airbnb, and that's just to name a few. They think that the promising companies of the last cycle, all right, so the last crypto bull market, that have real world application that had promise then are going to move on to attract new capital and attention moving forward. All right, so they've actually already exceeded their initial capital raise. So their target was 450 million, and I think they're at 515 million. So Andreessen Horowitz knows that out of this market will come what are our own versions of, essentially Amazon, Google, Microsoft, etc. Right? So it is important to understand that them being a venture capitalist fund, they have a little bit of a different timeline than someone like short-term oriented traders or short-term oriented investors. Okay, venture capitalists are known to make large amounts of investments on the off chance that they hit one home run every 10 years. Okay, so it's not like they are, let's say that they make 20 investments that they think that they're going to hit on 15. Okay, a venture capitalist firm might make 30 investments and expect to convert on, let's say, 2 or 3. So you could call them long-term investors, with the exception that maybe they have a low hit rate but a very high expected return. So they're expecting those kind of asymmetric returns, right? And those kind of diamonds in the rough, 1 out of 1,000 chances, right? So Andreessen Horowitz, Mark Andreessen, has been a longtime believer in crypto, and I think that this is really positive news. And I think that we're going to see this more and more from the traditional space in the near future. Now, crypto was a good example of the Gartner hype cycle. And the Gartner hype cycle is basically where the hype outpaces the tech. Okay, so in 2017, in 2018, essentially we had the hype that was well ahead of the technology, right? During the beginning of 2018 and the end of 2017, all you heard about was all different tokens and coins that were being built up for, such and such business, and a lot of them got really ridiculous, right? So There was a lot of excitement. Everyone had their favorite token and their favorite platform and company. They were going to be putting dog biscuits on the blockchain, but obviously the hype exceeded the tech. So that's what the hype cycle is. That was the same thing with the dot-com bubble. All right, everyone got very excited. There's a ton of investment in the space, and the technology still was in development and hadn't had time to catch up. So crypto is a good example of this. All right, where the hype outpaced the technology, but now we might be approaching that inflection point where the technology is catching up. So, this is a good question for you guys. Do you think that the technology at this point, at 2020, after the halving, has finally caught up and that we will see some of these smaller, tokens and cryptos begin to really take off for 1,000% gains again? I don't think that it's going to be the same way that it was previously where we had assets across the board doing it, but I think that we're going to see the same sort of effect that we saw in the dot-com bubble where, maybe 5 out of the 50 horses in the race really go to do massive things. So this is the article I want to mention, and now I want to get over to something that I think can be a very useful way of looking at the market and something to consider at all times when you are trading and you are investing. You always should know where other participants currently are and where they're interested in. So we're going to get over to that right now. All right, so this first concept is a concept that we really drill home on the BlockRoots platform. We've completely built our platform around the concepts of market profile and order flow. And while you might not have a thorough understanding of either of those, this is a very useful theory and way to look at the market. Okay, and it'll make a lot of sense once we start to go over it. So you've probably heard the term that price is always seeking buyers and sellers, but you might not understand what exactly that means. So there is a theory that was popularized back in the 1980s by a guy named J.P. Staudemeyer, and it's called auction market theory. And essentially, markets are a two-way auction. Okay, so if we talk about equities, if we talk about crypto, commodities, it doesn't matter. Buyers and sellers are taking place in a two-way auction. A one-way auction is similar to the auction that was on the YouTube thumbnail, where you have participants in suits, in that case, raising up paddles to place bids to buy something. So typically in an auction, you'll have, let's say, cattle, and the auctioneer will raise the price of cattle, and buyers will chase it up until the auctioneer raises the price so high that the volume in the room begins to drop. Buyers are not interested anymore, and the auctioneer begins to walk price back down to find buyers again. So in that case, the asset or cattle is seeking buyers by dropping the price. The auctioneer is seeking buyers. In a market, such as trading Bitcoin, price is seeking both buyers and sellers. So it is a two-way auction, and it's essentially trying to find and settle in or gravitate towards fair value, which is basically an agreement between buyers and sellers. So when I share a TPO chart or volume profile chart and we have that red line that sticks out usually, that's the point of control. So if we're looking at a volume profile, and I tried to draw one here, this is a very balanced profile, okay, the distribution of volume over a given area. If we're looking at a point of control, that is where the most volume occurred. If we're looking at a TPO point of control, that's where price spent the most amount of time. Okay, so what we're looking at is the area where buyers and sellers were in most agreement. Okay, in an auction, in a market such as Bitcoin, trading Bitcoin, prices rise to the point where buyers become uninterested in buying more. Okay, and then sellers take over. So sellers begin to sell from those levels. And then price lowers to the point where sellers become uninterested in selling anymore at that value, and buyers become more interested in buying. So we see this occur throughout ranges, and this is just an auctioning process that takes place through ranges of one side of the market constantly making its presence known and the other side becoming less and less interested. And on a large scale, within a large structure, this might not look like much. If you're looking at this on a 5-minute chart, it's going to look a lot different if you're looking at it on a 4-hour chart, right? But constantly buyers and sellers, or price is moving to find liquidity, in this case, find buyers and sellers, all right? Now, time, one of the theories of auction market theory is that time should govern these opportunities. So if an asset is valuable and we drop it in price, then it shouldn't spend too much time at the low, right? We should see that an asset that is valuable will be bid up immediately, right? If I had, Mercedes Benzes and we were selling G-Wagons to come up right off with a vehicle right off the top of our head. If a G-Wagon is $100,000 and I drop the price tomorrow and say G-Wagons are $20,000, how many G-Wagons do you think will be available the day after, right? Probably not a lot. We're probably going to see that opportunity bought up pretty quickly. And if an asset is bullish, the idea should be the same, right? If Bitcoin makes drops rather Bitcoin drops in value, we should see these opportunities bid up very quickly. So time governs these opportunities. So we could also consider that the volume on a trading chart is similar to the volume on something like an auction room. So if we're looking at a trading chart and we're looking at the volume at the bottom, then we could say that that volume confirms the level of interest at any given level within price, okay, or at any given price, okay, or rather at when Bitcoin is at any given level, okay, or at any given price, excuse me. So when people are interested in higher prices, they're going to continually bid it up. All right, we'll see an increase in volume. So when Bitcoin moves out of ranges, you want to see that when Bitcoin has come away from fair value and is above a level that was previously heavily sold or defended by sellers, that when Bitcoin moves through this level, you want to see that buyers are interested in these higher prices. You want to see this level confirmed with higher prices. So consider it the same way you'd consider an auction room. If Bitcoin drops in value, you want to see the auction room, you want to see the volume rather in the room begin to go up. Okay, that's how participants are going to be expressing their interest. All right, so you can imagine the sort of cacophony and loud, raucous noise that you would hear in an auction room if you drop the price of an asset. So the same concept works within volume in a market, right? So when price is dropped in value, we want to see buyers bid that level up. If it's going to hold, we want to see volume really increase. The last thing you want to see is that sellers become more interested in lower prices, all right? In a balanced auction, you're probably going to see sellers become more interested at the highs, and you're going to see that buyers become more interested at the lows. Within a balanced auction, within an area that is more or less maintaining a certain fair value level. Okay, so market structure is going to be defined by these areas where one side has overpowered the other. So on a large enough time scale, if we're looking at this this is, our weekly chart, the areas where buyers overpower sellers will be our weekly swing lows, all right? And the areas where sellers overpower buyers are going to be where our weekly swing highs are. So just a crude idea of how to understand these major levels within market structure. There are levels where there was a massive imbalance, in this case, between buyers and sellers, okay, where they are not in agreement. So that's just one way to sort of think of a market, right? So it's a theory, right? It's just a theory. It's auction market theory. That's just one way that you could look at things to really understand what we mean when we say that price is always seeking buyers and sellers, all right? So it's a two-way auction. And this next thing that I want to go over should really help you understand what makes levels more important than others, what makes levels insignificant, okay, and why it's important to understand at any given time where certain participants might come into the market, because you don't always have, it's not always that, it is not rather that all buyers and sellers are created equal. There are different types of buyers and there are different types of sellers. So let's go take a look at what we mean by that, right? All right, so if you follow me on Twitter, you've probably heard me refer to levels as major contextual levels, inflection points. This is swing highs, swing lows within greater market structure. Now, these levels all have one thing in common, and this is where we currently are right now, and hopefully this will put this in perspective for you. So these are areas within market structure. They're higher time frame market structure, and they bring a ton of participation into the market. So this whole concept of participation needs to be understood. There is not just one type of buyer and one type of seller. There are many different types of buyers and many different types of sellers. And at any given point, you should always know where you sit with relation to greater market structure and with relation to these areas where we do see an increase in participation across the entire spectrum. Okay, and that means that levels where every single type of market participant gets involved. Okay, so these are levels, major levels typically are levels where we see a ton of, high time frame, mid time frame, and low time frame participation begin to converge. So I did a little artwork and I put together something that will hopefully give you a better idea of what I mean and what you're up against and how you should begin to think of things. All right, so essentially we have three types of participants in the market. All right, when it boils down to basically three types. And after we go over this, you'll probably have a much more thorough understanding of just what we're up against, where we currently are at this sort of 10,000 level, because right now we're at an area where all participants are in the market. All right, all participants have something at stake. And if anything, we're fading a greater force by trying to buy through this level before it has been broken. So just keep that in mind. So first we have low time frame participants. So we're looking at right here an example of a 5-minute chart. So we have the 5-minute high, the low, in this case a range is beginning to form. So low time frame participants, they are your higher frequency traders. And this doesn't just mean, high frequency trading systems. I just mean traders that are trading more frequently, taking more trades. They're your scalpers. They're trading microstructure, intraday ranges. They're trading low time frames. All right, someone who's trading a 1-minute chart, a 3-minute chart, a tick chart, any low time frame chart, they are your low time frame participants. Okay, they're not really interested in the big picture. So your low time frame scalpers, your high frequency traders, they're not really interested in what's going on after the halving. It doesn't really affect them within their 5-minute range. They're more interested in, if anything, technical levels. They're in and out. All right, they're rapid fire. They're, again, high frequency. They're taking a lot of trades. They might be traders that have a higher hit rate, a lower expectancy. But this is just one type of participant. The next type of participant we're going to get to will put these types of participants in perspective. So the next type we have are your mid time frame participants. So this is a chart that also includes our lower time frame participants. So now we're zoomed out onto the 4-hour chart. So that previous range, okay, this 5-minute range that was beginning to pan out where your lower time frame traders are trading, that's taking place within a larger structure. Now your mid time frame participants are your intraday traders, your swing traders. These are longer duration, but it's not exactly position trading. It's not exactly investing. They're just not as rapid fire. They're not that high frequency sort of approach. Okay. This does take some consideration to the bigger picture. All right. Someone who might be a swing trader, holds a position on for a few hours or even a few days. Those are your mid time frame participants. This is what occurs between the macro and the micro. All right. So if we're trading and we're a lower time frame participant and we're trading this structure right here, really the only thing we're concerned of is this high, right, and this low. We might be trading the same way that we talked about within auction market theory, where we are essentially fading the moves down and fading the moves upward and taking advantage of mean reversion within this structure. If we are trading on the mid time frames, okay, and we're more of a swing trader, then right now we're probably approaching, if we're looking at this structure, we're approaching a significant technical level. We're at a significant resistance within the mid time frame, and maybe the optimal area that we're interested in is lower, is down here at this swing low. Okay, this is the upper and lower bounds for the structure that we're probably most considering. We're not really concerned with what's going on in these low time frames down here though. And any trader who's trading within this structure is also not really considering what's going on necessarily up here or down here. Now, if we're a scalper and we are trading within this lower time frame and this high is closer to a level that is also important to mid time frame participants, then we should keep that in mind, right? Because then at that point, any level of activity up here might be increased because now we are within greater market structure. We're taking in consideration a step up from our time frame. The last time frame that we have to consider, and the time frame that is in play now, is the higher time frame player. Now, these are your position traders, your investors, your long-term swing traders, okay? These are traders that are considered with the macro picture. They're not getting in a lot of positions. They might get in a few trades a month, a few trades a year. Okay, and they might also scale into the market over a larger span of time with what is likely larger positions. So this is where you're likely going to find your whales. So what we have here is a higher time frame chart of Bitcoin on the daily, and this also includes these lower time frame charts within it. Okay, so now you can see that to the higher time frame player, that these lower time frame levels might not be as important. But on this specific chart, there is actually a sort of convergence between all time frames. So we have the lower time frame resistance, we have the mid time frame resistance, and now we're at a higher time frame resistance level. So we have a ton of participation in this area. So the higher time frame trader, they typically will pay attention to these major contextual levels and swing points because these are areas where they could cleanly define their risk. They're getting involved in larger swings. They want to be able to define a more attractive risk to reward trade. And we're approaching one of these levels right now. So we are at a level where all participants are in the market, okay? Your smaller time frame participants might not really care, but your higher time frame participants are paying more attention to this level. So if you're a swing trader, and this is why, we share this on the BlockRoots platform, this is why I talk about this on Twitter. If you're a swing trader and you're still looking at swing positions up here, you have to consider that the level that you should most consider is the level that is right in front of our face, because this is a level where higher time frame participants are brought into the market. So hopefully this very simple, rudimentary example gives you an idea of, different types of buyers and sellers we have in the market at any given time. Also, if we're looking at this right now from the higher time frame players' point of view, if the market moves down just slightly, higher time frame participants aren't really going to be eager to buy this up. They're going to get involved at higher time frame levels. So if you are looking for the next major level to place a bid at or place a limit order to buy, and we're looking at say we have a major pullback in the making, then it makes sense to look where the larger players are looking, okay? Any of these levels in between are your intermediate levels, and they're not as significant because you don't have, in this case, you don't have the major market flows moving with you. So this is sort of the same idea if you're a momentum trader or you're a trend follower in traditional markets. This is why you have a chance to get in front of larger players and front run them, because we sort of have an idea of where larger participants are more likely to get involved. Okay, they might get involved around greater areas of market structure. They might get involved around, a volume weighted average price. But this is always important to understand. Okay, so this is one of the things that we're dealing with right now. We're dealing with one of these major levels within market structure, and it's actually this structure right here. And now we have a ton of participation coming into the market. So we have to deal with this force. And that's why anyone who is taking a long right here is kind of just longing into resistance. And it is every kind of resistance you can imagine. If we flip this level, then we're flipping this level for every kind of participant, right? If we're above this 10,500 level, well, now you have the bias beginning to switch for your scalpers, your swing traders, and your higher time frame position players. And in that case, you have more flows and more momentum that'll likely be behind you. So in this case, it's all about just having the wind at your sails. So these sort of things are the things that we teach on the BlockRoots platform. If you're not already familiar with it, go to BlockRoots.com, check it out. We have a referral program. If you're a member and you get enough people to sign up, then your membership is free. It's $49 a month. It's the most, it is, in my opinion, the most bang for your buck. I don't think that there's any other platform out there right now. And in the last week, the only thing that I've been thinking of, and Josh and myself have been thinking of, is just ways to improve it. So we think very highly of it. We have an incredible community, and all we're trying to do is improve upon it. So check out BlockRoots.com. If you haven't checked out Phemex, go to Phemex.trade. They have the best derivatives platform out there, and it'll likely become the best spot platform as well with the new spot asset introduction. But that covers it, guys. Hopefully this has been an informative video. Everyone have a fantastic week.